We can prevent bank runs, hopefully, by restoring depositor confidence through deposit insurance. As of June 30th, 2008, 4.6 trillion of the 7 trillion domestic deposits were insured. Today, I can almost confidently say that every deposit of a United States bank is insured. How did that come to be? Well, a couple of things happened. First, deposit insurance, which we've traditionally since 1980 has been $100,000, was increased by the bailout bill, which was passed October 3rd, to $250,000. That's for banks, savings associations, as well as for those of you who might have your money in the State Employees Credit Union. It has a separate deposit insurance provider, the National Credit Union Share Insurance Fund, but it also went up to $250,000. By statute, that's not a permanent increase. It is only to last until December 31st, 2009. Another little-known feature of deposit insurance is that it really can potentially be much more than whatever the stated amount is. So for instance, now that we're at $250,000, that is per account per person. And if, for instance, a husband and a wife hold a joint account, they are insured in that joint account up to $500,000. Each joint account holder gets $250,000 of deposit insurance. Moreover, the husband could have a separate individual account, so it's a different type of account at that same institution, and receive up to $250,000 of deposit insurance coverage on that account. Same for the wife. So in this particular example, if you were fortunate enough to have $1 million, you could and husband and wife could have it all fully insured at one bank. They could also, if they had more extra change than the $1 million, go to another bank and start the whole process over again. So that change on October 3rd as part of the rescue bill was intended to boost depositor confidence so that we would not experience this phenomenon of bank runs. For those of you who might have particular questions or concerns, there is an online deposit insurance estimator on the FDIC website where you can plug in your own numbers, make up numbers if you wish, to see how it works. Barely less than 2 weeks after the bailout bill was passed, on October 14th, the Treasury and the boards of the FDIC and the Federal Reserve invoked another provision called the systemic risk provision in a statute that was passed in 1991, the FDIC Improvement Act. And they said, maybe that's not enough, what we did in the bailout bill, and we're going to use the systemic risk provision to further increase deposit insurance by guaranteeing deposits above $250,000 that are held in non-interest-bearing checking accounts. And these would typically be commercial deposits for which banks are not permitted by law to pay interest. And the amount of these accounts could be quite high on various days. If you're getting ready to run your payroll for the month, there would be a lot of money in that particular account, well in excess of the FDIC deposit insurance threshold. So again, for a temporary period until December 31, 2009, all of these non-interest-bearing deposits will be fully insured up to the entire amount of the deposit. Our own local institution, Wachovia Bank, was apparently the victim of a bank run the Friday before Citigroup announced its potential acquisition on a Monday. And this was commercial depositors who were fearful of Wachovia's ability to repay their deposits and who did exactly what Jennifer just described and withdrew a lot of money from the bank. If the bank runs out of cash, the bank's then recourse is to borrow more money, which may not be available to it, as Jennifer alluded to, or to liquidate assets, potentially at a fire sale price. So that's what led Wachovia into the arms of the FDIC for a potentially assisted acquisition by Citigroup, which was then subsequently preempted by the Wells Fargo bid. So the only deposits that are not insured at this point in time are interest-bearing deposits that exceed $250,000 in one single deposit account. Second thing that this temporary liquidity guarantee program did was to assure the lenders to banks, the other people that the banks need to get money from, if the bank is issuing senior unsecured debt to a lender on or before June 30th, 2009, this will be fully guaranteed by the U.S. government. So that lender should know the full faith and credit of the United States Treasury is backing my loan to this bank. Whether I'm even though I'm not a depositor, if I'm a lender, I will get repaid. Both of these provisions are presumably funded by the banks themselves, not by taxpayers. So this is not being funded through the bailout bill, but there is a surcharge for deposit insurance that's charged to banks to cover these excess amounts, and also a fee that will be charged to write the guarantee for the debt of the bank. Another thing that was done as part of this systemic risk provision was a partial temporary nationalization of our banks. Banks and bank holding companies may now sell preferred stock in themselves to the United States. There are certain limits on how much they can sell, and the first $250 billion of the $700 billion bailout is committed for this specific use. And Don will talk a little bit more about it, but the actual authority to make the investment is coming from another statute from the 1991 FDIC Improvement Act and its systemic risk provision. I have quotes around voluntary, and the reason is half of this money, $125 billion, was basically foisted upon the 9 largest banks and bank holding companies in our country. $25 billion to Bank of America, JP Morgan Chase, and Citigroup, and $20 to $25 billion to Wells Fargo, presumably after it has acquired Wachovia. The two investment banks, which became bank holding companies before this provision was invoked, Morgan Stanley and Goldman Sachs, are also going to be beneficiaries of this preferred stock investment. Now, there is a cost to these banks. They must pay the United States government quarterly dividends of 5% per year for the first 5 years that this preferred stock is outstanding, and then 9% per year thereafter. In addition, as part of this deal, the Treasury will receive warrants to buy common stock in the bank at the market price at the time they make their preferred stock investment in an amount that would equal up to 15% of their preferred stock investment. This is similar to both the guarantees of debt and the government investments in banks, two things that have been done in other countries, including the ones listed above and others that are not listed there. So we've got the FDIC. It is required by law to maintain reserves to cover its deposit insurance obligations that equal 1.15% of all deposits that it is insuring. And right now it is below the required ratio. It only has 1.01% of insured deposits held as reserves, because there have been 13 bank failures already this year. Furthermore, the FDIC estimates that losses from bank failures over the next 5 years, notwithstanding these various provisions to save banks that have been put in place, are likely to exceed $40 billion. And their current reserves are only $45 billion. So they have proposed to raise deposit insurance premiums that the banks pay on January 1 of 2009. Currently, the rates typically range between 5 to 7 cents per $100 of insured deposits, with an average of 6.5 cents. And that will double if this provision goes into effect to a wider range based on the riskiness of the bank's asset portfolio, its loan portfolio, ranging from between 8 and 21 cents per $100 of insured deposits, averaging at 13.5 cents per $100. And I just wanted to conclude with this look at our domestic banking industry. This doesn't include the foreign bank holding companies that are operating here in the United States. And this is as of the end of the first quarter of 08, grouped by asset size. So you can see Citigroup had over $2 trillion in assets, Bank of America and JP Morgan Chase over $1 million. I've underlined JP Morgan Chase because they're getting together now with Washington Mutual, which failed, and Wachovia and Wells Fargo are in italics because of their potential merger as well. So we put Wachovia and Wells Fargo together, and we get another above trillion-dollar bank. Washington Mutual goes away, and look how we fall off to very small number, or much smaller numbers after that in terms of size of banking institutions. So one thing that we may want to look for in the coming months is what will the banks be doing with this new preferred stock, this new capital that the U.S. government is putting into them. Hopefully, although there is no requirement that I can find in the statutory authority, hopefully they will be making loans with that capital. But another thing that they might also be doing with that capital is using it to further consolidate the banking industry, buying other banking institutions so that we close the gap some between the four largest and the others. So I will conclude my remarks there. And Tom Hazen, my colleague, will follow me.
I'm the first low-tech speaker. I do not have a PowerPoint presentation. I'm going to switch gears a bit and move away from banks to something else that's been talked an awful lot about in the press and the news, and that is the impact that derivatives have had on this whole situation. And today's biggest news being Alan Greenspan admitting to Congress that maybe he was wrong all along about his approach to derivatives. First, what is a derivative investment? It is an investment or a contract, normally between two people, where they are, for lack of a better word, betting on the price of an underlying asset. The derivatives market started in the early 1900s dealing with agricultural futures contracts and forward contracts and the like. There sprung up around the derivatives market, the futures market, a whole series of regulation dealing solely with agricultural derivatives. Over time, the use of these financial instruments expanded. Again, complexity becomes the word of the day, but expanded from agricultural derivatives, whether it's lumber futures or pork belly futures, to hard assets such as gold and silver and oil futures that certainly have an interrelationship with the financial markets, and then beyond that, financial futures. And that developed even further into what we now refer to as swap transactions, where basically people can hedge or bet or speculate on just about anything in the financial markets or any asset. Just to give an example that would tie into what we're talking about today, if I'm a bank that has some mortgages, and given out some loans, or if I'm someone who has purchased some of these CDOs, these securitized debt obligations, I might want to hedge or insure my risk of loss by owning these or having these obligations. So what I might do is enter into a contract with Don or Lisa, where I would pay them a premium, a price, and in exchange, if there were a default and I suffered a loss, they would pay me the loss I would otherwise suffer. So insurance is one way it's described. In fact, that's the way that Alan Greenspan described it today before Congress in terms of what these credit derivative swaps are. They are a way to insure against a risk of loss. It's a market that some people estimate is not only hundreds of billions of dollars, but hundreds of trillions of dollars, because it's not limited to people that have an actual risk. Don and I could simply make a bet on what's going to happen with the mortgage obligations or the loans that Lisa has made. If she's going to have a default, then I can bet that I want to gain on that because I want to take the risk that that may happen. Don, on the other hand, may think that that's not going to happen, so he would take the other side of that contract with me. So the question is, why aren't these regulated? And of course, that's been an issue that's been going on for years. Historically, up until about 1990, the only derivative contracts that could be traded by individuals and most institutions had to be done so on a centralized exchange, a futures exchange, that was regulated by the CFTC, the Commodities Futures Trading Commission. Then starting in the early 90s, a lot of these more complex, esoteric swap transactions started to get more and more play amongst institutional and sophisticated investors. Without going into the legal specifics of it, they tried to carve out an exemption from the commodities laws that basically allow these over-the-counter derivatives, namely those not traded on an exchange, to be traded without any regulation. Then in 2000, Congress passed the Commodities Futures Modernization Act of 2000, which, among other things, had the effect of blessing that approach to the over-the-counter derivatives market, namely not regulating over-the-counter derivatives, which includes credit derivative swaps that we've talked so much about and you've read so much in the news. So the question becomes, what type of regulation do we have if this derivative contract that I described were done as an insurance contract? Then the person giving me the insurance would be regulated under the law of some state, because insurance laws have state-based regulation, and Don's going to talk a little bit more about that. If we do it as a securitized loan, a securitized product, sort of a CDO, then the SEC might have some jurisdiction because securities are regulated by the SEC. But if we do the transaction as a swap, as a derivative contract, as sort of a bet or a hedge between two counterparties, then currently there is no regulation whatsoever. In terms of what's likely to be happening in the future, you see Chairman Cox of the SEC saying we should regulate CDSs, credit derivative swaps. The state of New York has announced that starting January 1st, it's going to regulate at least a large portion of the credit derivative market, credit derivative swaps, saying that however you describe them, you can call them a swap, you can call them a derivative, but it's really an insurance contract. So there's going to clearly be some sort of a jurisdictional battle now. The Treasury Department, there have been some thoughts about the Treasury Department now being the super regulator that's going to regulate everything. And I'll let others talk about the wisdom of some of these approaches. Basically, at this point, I will stop, and certainly if there are any questions about the regulatory or the banking aspects, we will take them up later as part of the question and answer.